Hello everyone and welcome back to Markets Analyzers. Today let's talk about three important topics, starting with our market's recent surge and reasons for the surge. Then let's talk about Indian IT sector outlook, and finally we will end the video with India's growth story in comparison to China and Vietnam. During 1990s, China and Vietnam were at similar stages more or less, but how our paths diverged after taking different routes, how our stories become different. So it will be discussed. It will be very interesting. Don't miss that part in the video. So let's begin with market's recent surge, the first topic of the day. In just a few days, Nifty 50 and Sensex have surged over 7%. Just earlier this month, things were looking scary. Global tensions, Trump's tariff drama, and a wave of foreign portfolio investors selling had shaken investors. But suddenly, everything seems to be reversing. So what's changed? In this video, first we'll dive into why markets fell in the first place, what are the reasons. Then let's talk about what triggered the sharp rebound which is happening right now. Then let's analyze the return of foreign investors, why the banking and financial sector is leading the charge in this rally, and most importantly, what all this means for you as an investor. So we will discuss each of these topics in a very easy and understandable way. So let's get into it. Let's begin with what caused this market fall. Let's rewind to 2nd April. US President Donald Trump announced fresh tariffs on several countries, which sparked global panic. Trade tensions usually signal slower global growth, or for countries like India, which rely on foreign trade and global capital, that's a very bad news, that's a red flag. Within days, the Nifty 50 dropped over 5%, hitting an intraday low of 21,743 on 7th April. Why did this hit Indian markets so hard? Because when global uncertainty rises, foreign investors pull out the money, currencies weaken, and overall risk appetite shrinks. India's markets are tightly linked to global capital flows, so even a tweet from Trump can ripple the dollar state. It was a classic case of panic selling. So, what sparked the recovery? Fast forward to the current times. Trump suddenly announced a pause on tariffs, which happened on 15th April, but only for countries other than China. That reduced global trade fears instantly. Markets reacted sharply. The Nifty recovered all its losses by mid-April and now has gained 7.43% from April 7 low. Sensex also followed the same route. This shows how sensitive markets are to sentiment and global headlines. One announcement flipped the trend completely. It wasn't just relief, it was a full-on rally. The real firepower behind this rally are FPIs, foreign portfolio investors. They have turned net buyers after months of selling, constant selling. In last 3 days alone, FPIs bought equities worth 15,492 crore. Meanwhile, domestic institutional investors DIS were net sellers of offloading 6,470 crore worth of shares. According to Alok Agarwal from Alchemy Capital, FIS buying over the 3 consecutive days is a rare in last 6 months, and it's true. The shift in FPI mood is a big deal. These investors often drive market momentum, especially in large caps and index heavyweight stocks. So their buying is a sign of renewed confidence, and markets love that. Yes, which sector led the rally? No surprises, it's the BFSI sector, banking, financial services and insurance. Here's why the sector is leading the rally. The RBI has cut interest rates, making borrowing cheaper in the previous MPC meet. Several banks have also reduced deposit rates, improving the net interest margin (NIM). BFSI holds a higher weightage in Nifty and Sensex, so when it moves, the whole market feels it, like it's also moving up. The top gainers included ICICI Bank, HDFC Bank, Reliance Industries, Bharat Airtel. So these stocks were some of the best performers during this recovery phase. So where do we stand now? Despite the rally, Nifty is still about 9% below its all-time high from September last year. Back then, FIS foreign investors began exiting due to high stock valuations, slowing corporate earnings and increased global risk. So while this rally is encouraging, we are not in an all-time high territory yet. It's more a recovery phase. Sentiment is still fragile. It can flip within days. What should you watch next? There is still a lot going on behind the scene. Here is what investors should track. I think there are 4 main things that we should track. The first one being inflation. India's inflation just hit a 67-month low. That increases chances of a more rate cuts and policy easing. The next one being bond yields. If bond yields keep rising, it limits how much the government or Reserve Bank of India can support the growth. So bond yields should not rise behind a certain point. The next one being earnings. We are in the middle of an quarterly earnings results season. If earnings disappoint, this rally could fizzle out. And the final one being currency and global cues. Any further tariff drama or global financial tightening can shake these markets again. As Akshay from Access Securities puts it, optimism is building, but we must also look at liquidity, earnings, and policy flexibility. So, the recent rally in Nifty and Sensex is powered by a perfect combo of Trump's tariffs pause, the first one being, then the return of foreign investors, and then the strong BFSI sector momentum, banking and financials, along with insurance. This sector, the stocks are moving pretty much very good and improving macro signals like lower inflation. So, all these things helped the markets to move higher, but this isn't the time to go all in blindly. Be selective, look at quality sectors, focus on fundamental, especially during earnings season. This market is moving fast and smart investors are staying alert, not just optimistic. The second topic is about Indian IT sector outlook. India's $238 billion IT outsourcing industry just wrapped up one of its gloomiest weeks in recent times. First, TCS disappointed, then Wipro followed with a warning, and finally Infosys, India's second largest IT services company, dropped the curtain with flat guidance and a hiring freeze. So what's really happening here? In this segment, we are going to break it all down. Why Infosys Q4 results matter, what this means for tech graduates, the macro factors behind this IT slump, how generative AI could reshape the entire industry, and whether there is any silver lining at all. So we will discuss all these matters. So let's, without wasting any time, dive in. Infosys wrapped up FY25 with a revenue of $19.28 billion. It's a 4.2% year-on-year growth in constant currency terms. Constant currency means that the company is reporting its revenue without impact of foreign exchange rate fluctuation. IT companies in India like TCS, Infosys, Wipro earn a huge chunk of revenue from clients abroad, especially in US and Europe. So their earnings in USD amounts through United States dollar, similarly in Europe, Euro, in Britain, Great Britain, pound. So that need to be converted into INR for reporting the number. But currency exchange rates change all the time. So to give a clear picture of how the actual business performed, companies also report revenue growth in constant currency terms. Coming back to growth of 4.2%, it's good news. They bet unleashed expectations. But the problem is, even after beating estimates, they missed their own target of 4.5% to 5% growth and projected only 0 to 3% growth for FY20. That's their weakest guidance since 2009, which is approximately 16 years when the world was dealing with global financial crisis during that. And the pain didn't stop there. Net profit for the full year fell by 0.28%. Q4 revenue dropped by 4.23%. Life science business, which is one of the major business for them, took a hit. Headcount commentary, they did not talk about that. They remained silent. No hiring targets, no clarity, just cautious tones like Wipro and TCS. If you are a student graduating from an engineering college in 2025, that's not what you want to hear. With Infosys, Wipro and TCS all avoiding hiring projections, it's clear the sector is entering a deep freeze in recruitment. Why would they recruit new people if they don't believe that their business will have more work to do? India produces nearly 1.5 million engineering graduates every year, many of whom look TCS, Infosys and Wipro as their first choice. A slowdown in IT hiring could leave thousands of freshers scrambling, adding pressure on already competitive job market. What's causing this sudden caution? The big culprit, macroeconomic uncertainty. Trump's tariff war triggered massive global instability. Even though there has been a pause in tariffs, clients are unsure. Large US and European clients are slowing decision making. Many have paused or cancelled discretionary tech spendings. TCS said it started seeing weakness from March onward. Infosys echoed that same sentiment, with CFO JS saying that their guidance already bakes in more deterioration in the environment. CEO Sahil Parekh added a slight ray of hope, saying things can change quickly. But for now, it's more hope than reality, he said. So next, let's move on to the impact on revenue, profit and margins. Let's talk numbers. Infosys Q4 numbers. Revenue 4.73 billion, which reduced by 4.23%. Net profit $813 million, which increased by 1.12%. Operating margin, it stood at 21.1%. It also increased by 40 basis points in comparison with year on year. Interestingly, Infosys did see margin growth, only the second among the top 4 IT companies to do so, after Wipro's 100 basis points gain to 17.1%. But here's the catch. Revenue decline is more important. Revenue is slowing. Clients are pulling back on discretionary spending. Discretionary spending is being cut and there is no visibility for a quick recovery. Investors aren't impressed either. Infosys shares fell 3% in pre-market trading. Wipro and TCS also saw decline after the results. And if things weren't tough already, now comes generative AI. Keith Bachman of BMO Capital Markets said, generative AI will act as a deflationary force for service delivery. In simple terms, AI, which is generative AI, could reduce the need for human programmers in application development and maintenance, business process outsourcing BPOs, even in digital marketing and testing. As clients shift to automation and AI tools, demand for traditional IT services could fall even unless Indian IT companies adopts fast. This isn't just a tech buzzword anymore. It's a real strategy threat to legacy outsourcing. So to sum it up, Infosys, Wipro, TCS have all raised red flags. Hiring is frozen or deeply cautious. Growth projections are weakest in a decade. Clients are nervous and slow to spend. And generative AI could eat into traditional IT margins. So what should investors and job seekers do? For investors, look for IT companies moving towards AI, digital transformation and cost efficiency. They should be rapidly evolving with the changing time. For students, we should try to upskill in areas like cloud computing, cyber security, and as even AI, artificial intelligence. The old BPO coding jobs may not come back the same way. So the Indian IT story isn't definitely over, but it's entering a new chapter, is what I would say. Friends, if you until this point find the video informative, please do like the video, subscribe to our channel Markets Analysis for more such content, and share the video with your friends and help us grow the channel. So next, let's move on to the final topic and the most important topic of the day. The bigger picture India can't ignore is the heading of the topic, I would say. This topic provides some great information. Please try to understand this carefully. India's growth story is one of the most talked about in the world. But when you really zoom out and compare us to countries like China and Vietnam, some hard truths start to show. So in this topic, we will talk about three powerful and important ideas. How China, Vietnam and India took very different paths after 1990 and who gained more. After 1990, all these three countries were at similar positions, but where have we now and why it happened? The second one being the role of United States of America in shaping our India's economic decisions. Then the final one, industrial policy. Why industrial policy could be India's missing piece in the puzzle. Industrial policy means government strategy to promote the growth and development of specific sectors in the economy. Stick around because this is not just about trade and GDP. It's about how India can finally stop being a market for others and start being a maker for the whole world. Let's go back to 1990s. India per capita GDP was around $370. China, it was about $318. Vietnam was about just $130. Per capita income is calculated by dividing the total income of the area by its population. So we have taken three developing nations which are at similar starting lines, but from there things went in very different direction. India after 1991 crisis took a loan from IMF, International Monetary Fund, and accepted the following conditions: to open up our economy, to cut back an industrial policy, to liberalize trade. Basically it means let the market decide everything. Well, it's honestly one of the better things that India did at that time, but after opening up our economy, we lost competitiveness in manufacturing. Cheaper imports, especially from China, crushed our local business. We joined the World Trade Organization in 1985, and again we cut duties and tech imports to zero by 1997. But if we compare it with China, they did becoming a manufacturing powerhouse, and we ended up as a market for them to dump their products. If you remember, we joined the World Trade Organization in 1995, and we accepted to cut duties and tech imports to zero by 1997. But China waited. They only joined World Trade Organization in 2001, 6 years after we have joined. They signed the same tech deal in 2003, which is also 6 years after we have done. Why? Because they wanted to build their domestic capabilities first. You can't build a global brand without first protecting it at home. China understood this strategy very well. They gave their companies time to grow strong behind protective walls before facing global competition. They did not open up their economy like we did. They first built their companies very strongly. They allowed their companies to export, but they did not allow products from other countries to China. So this gave their companies an edge. They slowly built strong brands which were ready to compete with the world. Only after making sure that domestic capabilities are strong, they opened their economy. But in India, our domestic industries were weak. As soon as better products and cheaper prices start to get dumped in India, our industries weren't able to compete with them. India opened too fast, exposing fragile industries to tough competition before they were ready. Fast forward to today, India's per capita GDP is up 7.7 times. Per capita GDP is calculated by dividing GDP, gross domestic product of a country, by its population. So it gives GDP per capita on a per person basis. So this metric provides insight into the average economic output per individual and is often used to compare the economic performance and standard of living across the countries. So India per capita GDP per person output has increased by 7.7 times, whereas China increased it by 41.8 times. Vietnam has increased by 48 times. So in comparison to India, their performance is very much way above us. That's the power of building their domestic capabilities before opening up. Next, let's talk about the US influence. Now enter the United States, India's biggest software customer and also one of the top trading partners to India. But the US hasn't just traded with India, it also tried to shape our economic policies. Let's be real. America's concern is not Cambodia or Bangladesh or even Pakistan. It's not about fair trade. It's about China's rise in the world order. China didn't play by Western economic rules. China did not listen to what US was telling. And now they end up being the world's second largest economy, competing in AI, chips and advanced manufacturing with the United States. Meanwhile, Trump era tariffs hit even poorer countries. Why? Because US wants global obedience to its trade rules. And when India resists, say, by protecting our agriculture or raising import duties, it gets labeled as protectionist. Here is what the issue. The US wants to export more food and goods to India. Their farmers are heavily subsidized. Our farmers are not. Their industries are globally dominant. Ours are still developing. Should we just open up and let them flood our markets? Of course, the answer is not. That's what China did during 1990s. We need to trade smart, not just trade more. Back in 1990s, India actually had a lead in some sectors like machinery, electricals, trucks and power equipment. We exported these to other countries. But after 1991, we gave up on building things ourselves and became a big importer instead. Meanwhile, China kept building. Now we import many high-tech goods from them. Goods once we had the capacity to make within our country. Some people say it's fine, we'll just import and re-export. But here's the truth. You don't build a strong economy by trading other people's product. You build it by making your own. That's why we need to bring back a well thought out industrial policy. Invest in local manufacturing, protect infant industries until they are ready from foreign supply. Focus on tech, energy, electronics, textiles. They can employ millions of workers and ensure that Indian workers and MSMEs are part of global supply chains. We can't rely on just being a software exporter or a global market for American and Chinese goods. We have to become a global maker, not just a global consumer. India is working a tightrope between US and China, between global trade and local needs, between growth and inequality. Yes, we should welcome global trade. Yes, we should compete internationally, but we must also protect our own capabilities first. It's time to stop chasing GDP headlines and start focusing on real, long-term strength. That means skills, factories, innovation and resilience. Let's not be afraid to rethink the free market script that we have been following. Because if you forget how China and Vietnam did it, we might just keep playing the catch-up forever. Those who don't learn from history are doomed to repeat it. So, friends, I hope this video was informative to you. If you found this video informative at any stage, please subscribe to our channel Markets Analyst, hit the like and share the video with your friends. So, that's it. Thank you for watching once again.